Hello and welcome back. So PayPal crashed a couple of days ago, and that crash wiped out over $50 billion in terms of its market cap. And the main reason for that is the lowering of their guidance, their profit outlook. And let's take a look at this article here from Forbes, because it kind of gives us an interesting point of view and a good idea on what happened when the earnings were reported for PayPal. So, it plunged nearly 25% to under 133 and currently sitting at less than that, which is very, very interesting. And the main reason was a disappointing outlook. Outlook because of the earnings projected for the next year, really. Now, what happened here? The payments company lowered its profit outlook for the current quarter and lowered forecasts for full-year revenue growth to between 15 and 17% below the 18% expected by analysts. Now that's very, very interesting. We need to examine what the company was doing historically, see whether that's the norm or they are actually going lower than the norm or how far they are from the norm. And so the thing that I really took out of this and was the most dangerous part of the earnings report really is that the company is losing business at a faster pace than expected from one of its biggest customers, and that's eBay. I mean, pretty much everybody who has shopped from eBay knows that PayPal is a very, very integral part of their payment system. And so the fact that this customer may be, not as a prime anymore and losing their business from them, that's a very, very concerning thing. And it's probably the most concerning thing that I read here. So let's still take a look at the financials of the company, because there is always a price for every company, depending on what they are doing financially. You will see here that the company has been a high flyer and right now is sitting at 124, almost 60% down from what it used to be. That's absolutely massive. And it actually gave us an even deeper discount yesterday because of the Facebook crash. Everything crashed, and especially the Nasdaq. So, what we can discover from this here, you will see the interesting part, currently sitting at a PE of 30 and expected to grow less, which actually to become less, which means that the company is going to grow its earnings per share. And a price to book of 6 is a little bit overvalued, but that wouldn't worry me too much. What about the outstanding shares here? What's going on? Yeah, they're getting decreased, so that's good. When this happens, it means that the company is buying back shares. That's a good thing for current investors, because their shares are now worth more. So, let's take a little bit of a closer look now at the income statement of the previous years, what was going on here. You will notice that the revenue growth over here for every year, for the most part, used to be sitting at around 20 to 21, some years around 18. So, what they are projecting, what they are saying is that we're going to be looking at a year that's going to be more like 2019 here, close to 15 to 17% of revenue growth. Now, that's not very worrying to my eyes. I mean, I'm not very worried about this. And this is typical for the company. I mean, okay, it's not their best year, but still a 15 or 17 growth, percentage of growth is fine with me, and it's very close to what they were doing. I mean, you cannot always expect for growth to keep increasing. I mean, we're still looking at a very similar level, so I'm not worried about that. And now let's take a look at the net income. Net income used to be 1.8 billion and now is approaching 5 billion, which is growing nicely over the years. Good to see. The balance sheet of the company, interesting to see what's going on with their assets here. And I want to check two things. The total liability is sitting at $52 billion right now. And the total equity from 16 to 22, increasing nicely year over year again. So that's good to see. The company is making money and storing those assets. And the cash from operation activities here, 2.5 billion back in 2017 and now sitting at 6 billion. So increasing nicely as well. So companies making money from operations, which is obviously the most important thing. And investing some over here, investing mostly in market securities, I'm saying. And also acquiring. Maybe they acquired the company back in 2020. And also still investing in market securities. Good to see. What about their financing? So the financing is in the positive here, which means that they got a lot of debt and that's exactly what happened. They issued debt here, quite some, 7 billion, and then earlier 5.5 billion. I mean, that's a payments company, and I'm sure they're using money to leverage their money, and so I wouldn't again be too worried about that, as long as they are making good enough cash flow to be able to repay when it's needed. And let's take a look at the free cash flow right now. It used to be 1.9 billion and has approached 5 billion, which was basically the same as in 2020, really. Now, $5 billion in terms of free cash flow, and they had 52, I believe, billion dollars in terms of total liabilities, which means that it would take them 10 years of free cash flow to pay back their debt as a whole, which is a little bit more than I would hope for. I would want them to keep it down to 20, maybe $25 billion if possible in terms of the total liabilities. But let's take a look at whether their debt compared to equity is too much. It's not. So they have about actually $1 of debt, $1 of debt for every $2 of equity, even less actually than they actually have. So that's good. What about their multiples here? Okay, so the EV to sales multiples and the price to sales multiples are actually getting lower, which is a good thing, and much lower from 2020. This is a very good thing, because it means that you are getting more enterprise value and a better value for your money, really, because of the sales. Like this is a ratio between the enterprise value and the sales, and so the lower it is, the better, because you're getting more value out of the enterprise for more sales, really. So it's good to be having it as low as possible, because again you're getting more sales for the enterprise value. So this keeps lowering, and it's nice to see. Now let's examine the cash flow, and the cash flow is obviously the most important, the end all be all in the very end. And it's again, we can take it as a $5 billion company on average for its free cash flow a year, which means that if we give it a multiple of 20, that would take it to $100 billion for its market cap, as an expected market cap, sitting at 145 right now, which means that it's almost a multiple of 30. 30 multiplied by 5 would take it to $150 billion of a market cap. So we're looking at a company that has a little bit less than a 30 times free cash flow multiple here. Now that's a little bit more than I would want, just because the company is still growing, but it seems to be growing less in the next few years. However, their growth is predictable, so they have like a 15 to 20% growth for the most part. I am worried about eBay. I'm not gonna lie, this is probably something that I would want to take a little bit of a deeper dive and understand why and how much of the business they are losing, and also what part of their revenue comes from eBay potentially. Would be very interesting to examine. And so if this is if this is okay, and we can actually withstand this kind of customer loss in terms of the revenue of the company, then I would be willing to invest a little bit here, especially if the stock price goes down a little bit more. So if this keeps going down, and it can keep going down just because of the trend right now, if I could get it at around 100, I would be a happy person, because now I would be getting a steep discount, and if it's 100, it's gonna be at about 20% less than what it is right now, which means that we're looking at a 20% less of a market cap, which would take the company at about 110 or so. And then we're looking at a multiple of 22, about 22, if my quick calculations are correct. So I would be much more willing to invest in that level. Now, however, if you really want to invest in PayPal, you really believe in the company, it may be an interesting opportunity to add a little bit of money here and just wait it out, see if it drops more. This would be a prime opportunity for dollar cost averaging. Like if you really want to buy PayPal, just buy a little bit now and wait it out, see if it actually goes lower, and then you can buy more. So you can start with like 25% of your intended buy price, buy volume really. And just buy, if you are looking to buy, let's say 5,000, you can buy 25% of that 5,000, which is what, like $1,250 or something. So you can start off with that and see how the company progresses in the next few weeks and then potentially add more, especially if it goes down in price. So that would be an interesting thing. But hopefully that gives you an idea of what PayPal is doing. I'm generally speaking not very worried about earnings. I mean, earnings can go up and down, and especially in this climate, you can end up getting steep discounts for a lot of companies. So I'm not really worried about those in terms of the growth and estimates and guidance. The only thing that worries me here is eBay. That's my prime worry about PayPal. Other than that, if that wasn't the case with eBay, I would be much more interested in purchasing PayPal right now. But because of that, you may want to be looking at a little bit of a margin of safety. Just get a little bit of a lower price so that you are safer. Basically, that's what it means. So thank you for watching this. I hope you enjoyed. If you did, please like and subscribe. And I'd love to see you join our Discord channel. You can find the link in the description box below of this video. And in the meantime, take a look at this video that is about Facebook. Check what happened with their crash yesterday, really. So thanks for watching, and I'll see you soon. Bye-bye.